In 1971, Richard Nixon walked into the Oval Office and broke a promise the United States had kept for 27 years. He announced that America would no longer exchange dollars for gold. The system that had made the dollar the world's reserve currency was over. Markets panicked. Economists predicted chaos. 54 years later, the dollar is more dominant than ever. This is the strange part.
Before we begin, let me challenge you with something. This giveaway is conducted independently by this channel and is not sponsored, endorsed, or administered by YouTube. Somewhere in this video, I'm going to announce a chance for 3 of you to win $1,000 each. I won't repeat it, I won't pin it, and I won't tell you exactly when it happens. If you miss it, you miss it. So if you're actually watching, not just listening, stay sharp. Let's come back to the topic.
The thing that was supposed to destroy the dollar's power actually gave it something far more potent, something that doesn't rely on gold or trust, or even the strength of the American economy. And if you understand how this system works, you'll see why every major decision in global finance, from oil prices to why countries stockpile US Treasury bonds, traces back to a mechanism most people never think about. This is how the dollar won, and why that victory might be more fragile than it looks. Let's start with a basic question. Why does the world use the dollar? You might think it's because America has the biggest economy, or the strongest military, or because people trust the United States. And sure, those things matter, but they're not the foundation. They're not the mechanism. The real answer is structural, and it starts with a problem every country faces. How do you trade with someone who doesn't want your currency? Imagine you're Japan in the 1980s. You make cars. You want to sell them to Germany, but Germany doesn't want yen. They have no use for it, and you don't want Deutschmarks. So what do? You could barter, but that's insane at scale. You could try to negotiate a direct exchange rate every single time, but that's slow and expensive. Or you could do what everyone actually does. Convert everything into one neutral currency that everyone accepts. That currency is the dollar. Not because it's backed by gold anymore, not because people love America, but because everyone else uses it. The dollar is dominant because the dollar is dominant. It's a network effect. And once a network effect takes hold, it becomes almost impossible to break. But here's where it gets interesting. That network effect isn't just cultural or habitual, it's engineered, and the engineering started in the same decade Nixon killed the gold standard. In 1974, the US made a deal with Saudi Arabia. The terms were simple. Saudi Arabia would sell its oil exclusively in dollars. In exchange, the US would provide military protection and buy Saudi debt. This wasn't just about oil, it was about creating a structural need for dollars. Think about what this means. Oil is the most traded commodity on Earth. Every country needs it. And if every country needs oil, and oil can only be bought in dollars, then every country needs dollars. It doesn't matter if they like the United States. It doesn't matter if they trust the Federal Reserve. They need the currency to function. This is called the petrodollar system, and it did something almost miraculous for the US economy. Normally, when a country imports more than it exports, its currency weakens. People sell it off. But the US could run massive trade deficits, buying more than it sold, and the dollar stayed strong. Why? Because the world needed dollars to buy oil. Demand for the currency stayed high no matter what America did. It gets better, because when foreign countries earn dollars from selling goods to the US, they can't just hold cash. Cash doesn't earn interest, so they invest those dollars back into US assets, mostly treasury bonds. This creates a loop. The US buys foreign goods with dollars. Foreign countries take those dollars and lend them back to the US government by buying bonds. The US uses that borrowed money to fund its budget. Then it buys more foreign goods. The cycle repeats. This is why America can sustain debt that would cripple other nations. The system is designed to recycle dollars back into the US financial system. It's elegant, and it's completely dependent on one thing: everyone continuing to need dollars. But the petrodollar is only half the story, because there's another layer, another system that makes the dollar inescapable. It's called SWIFT, the Society for Worldwide Interbank Telecommunication. SWIFT isn't a bank, it's a messaging network. When a bank in South Korea wants to send money to a bank in France, they don't physically move cash, they send a message through SWIFT. That message tells the receiving bank, here's the money, confirm the transfer, update the ledgers. Most of those messages are denominated in dollars, even if the transaction is between two countries that don't use the dollar domestically, because the dollar is the lingua franca of international finance. And here's the kicker: SWIFT is technically a neutral cooperative cooperative owned by member banks around the world, but in practice, it operates under heavy influence from the US and European regulators, which means the US can weaponize it. In 2012, the US and EU kicked Iranian banks off SWIFT as part of sanctions over Iran's nuclear program. Overnight, Iran couldn't easily trade with the rest of the world. Their economy collapsed. In 2022, after Russia invaded Ukraine, the West removed major Russian banks from SWIFT. Russia's ability to conduct international transactions froze. This isn't just symbolic, it's existential. Being cut off from SWIFT is like being cut off from the internet. You can still function, but you're operating in the dark, using slow and expensive workarounds. And because most SWIFT transactions are in dollars, controlling access to SWIFT means controlling access to the dollar system, which means controlling access to the global economy. This is power, not soft power, not influence, actual structural control. Let's put some numbers on this. As of 2024, the US dollar makes up roughly 58% of global foreign exchange reserves. That's down from 70% 2 decades ago, but it's still more than double the euro, which sits at around 20%. The Chinese yuan, less than 3%. About 88% of all foreign exchange transactions involve the dollar on one side of the trade. Even when China trades with Brazil, they often settle in dollars. The US Treasury market bond is worth more than $46 trillion. That's larger than the GDP of China, Japan, and Germany combined. It's the deepest, most liquid market in the world, which means it's the safest place to park huge amounts of money. Central banks, sovereign wealth funds, pension systems, they all buy US debt because there's nowhere else that can absorb that much capital without distorting prices. And here's the uncomfortable part. The US national debt is now over $36 trillion. The government pays roughly $900 billion a year just in interest. That's more than the defense budget. Under normal circumstances, this would be catastrophic. Investors would panic. They'd dump US bonds. The dollar would collapse. But they don't, because there's no alternative. The Eurozone is fragmented. China's financial system is opaque and tightly controlled. Japan is stagnant. No other market has the combination of size, liquidity, and legal stability that the US offers. So the world keeps buying treasury bonds, not because they think it's a great investment, but because it's the least bad option. This is the secret. The dollar's dominance isn't built on strength, it's built on the absence of alternatives. But that's starting to change. In 2023, China and Brazil announced they'd begin settling some trade in their known currencies, bypassing the dollar. Saudi Arabia started accepting yuan for oil sales. India and Russia are trading in rupees and rubles. These aren't huge shifts, not yet, but they're symbolic. They signal that major economies are actively trying to reduce their dependence on the dollar. There's even a technical term for this now: de-dollarization. Part of this is driven by sanctions. Countries saw what happened to Russia. They saw how quickly the US could cut them off from the global financial system, and they realized if it happened to Russia, it could happen to us. So they're building alternatives. China launched CIPS, the cross-border interbank payment system, as a rival to SWIFT. It's small compared to SWIFT, but it's growing. The BRICS nations, Brazil, Russia, India, China, South Africa, have talked about creating a common currency to challenge the dollar. None of these efforts have succeeded yet, but they don't need to replace the dollar entirely. They just need to chip away at the edges, reduce its market share, create optionality. Because here's the thing about network effects. They're self-reinforcing, but they're also brittle. The dollar is powerful because everyone uses it, but if enough countries start using something else, even a little, the feedback loop reverses. Liquidity fragments, trust erodes. Suddenly, the system that seemed invincible starts to look vulnerable. And there's another problem, a deeper one. The dollar's dominance gives the US an extraordinary privilege. Economists call it exorbitant privilege. The ability to borrow in your own currency at low rates, the ability to print money without immediately triggering inflation, the ability to run deficits that would destroy other countries. But privileges create dependencies, and dependencies create vulnerabilities. The US economy is now structured around this system. The government relies on foreign buyers to fund its debt. Consumers rely on cheap imports paid for with strong dollars. The financial sector relies on the dollar's role in global transactions. If that system breaks, the consequences aren't just international, they're domestic. Imagine a scenario where major economies genuinely move away from the dollar. Demand for treasury bonds drops. The US has to offer higher interest rates to attract buyers. The cost of servicing the national debt explodes. The government has to cut spending or print money. Either choice leads to economic pain. Or imagine a faster collapse, a crisis of confidence, a sudden sell-off. The dollar plunges, inflation spikes, the Fed raises interests to defend the currency, borrowing costs soar. war, businesses fail, unemployment rises. This isn't science fiction. Currency crises have happened before. The British pound lost its reserve status after World War II. It didn't happen overnight, but when it did, Britain's global influence evaporated. The difference is, Britain's decline didn't crash the global economy. The dollars would. Because the world is so interconnected now, so dependent on dollar-based finance, a real collapse wouldn't just hurt the US, it would fracture the entire system. Trade would seize up, credit markets would freeze. We'd be looking at a global depression. The irony is this makes the dollar's position both stronger and weaker at the same time. Stronger because no one wants to trigger that collapse. Weaker because the system is too fragile to sustain the kind of strain it's under. So where does this leave us? The dollar is still the dominant global currency. That's not changing tomorrow, but the foundations are shifting slowly, quietly. Countries are testing alternatives, not because they think they can beat the dollar, but because they want insurance. They want leverage. They want to reduce the risk of being cut off.
Quick pause. This is the moment I mentioned earlier. If you want a chance to win $1,000, here's exactly what you need to do. First, subscribe to the channel. Second, like this video. Third, do not share this video. And finally, comment the word finance below. That's it. This challenge will officially end on January 25th, 2026. Everyone who completes all the steps will be entered into a random comment picker. 3 persons will win $1,000 each. If you're selected, I'll reply directly to your comment with next steps, including how to confirm your email securely. No extra rules, no tricks. Now, let's get back to how the global money system actually works.
The US, meanwhile, is in a strange position. It benefits enormously from the current system, but it also takes that system for granted. Every time it uses sanctions, every time it weaponizes the dollar, it gives other countries another reason to look for exits. And the math is getting harder to ignore. The debt keeps growing. The deficits keep widening. At some point, something has to give. Maybe it's a slow erosion. The dollar's share of global reserves drops from 58% to 50%, then 45%, then 40%. It remains important, but no longer untouchable. Maybe it's something sharper, a crisis that forces a reckoning, or maybe the system holds. Maybe the lack of alternatives keeps the dollar on top for another 50 years. Here's what we know. The dollar's power isn't accidental. It's engineered, built on oil, payments infrastructure, and the sheer size of US financial markets. But engineering can be reverse engineered. Systems can be replaced. The question isn't whether the dollar will last forever. Nothing does. The question is what comes next, and whether the transition, when it happens, will be managed or chaotic, because the world has never seen a reserve currency collapse in the age of globalization, and no one really knows what that would look like.